Regulation D is the backbone of private capital in the United States. If you've ever heard of raising money from accredited investors, this is where it comes from. Today, we'll break down everything founders need to understand: what Regulation D is, how 506B and 506C actually work, what accredited investors are, what filings are required, and what rules govern how you solicit or communicate with the public. No hype, no myths, just the actual mechanics behind one of the most powerful tools a private company can use. Let's start with the basics. Regulation D was created to make it possible for companies to raise capital without the cost and complexity of a public offering. It's used for private placements, which means the securities you sell are not registered with the SEC, but the exemption is. There are two primary rules inside Regulation D, the 506B and Rule 506C. Both allow companies to raise unlimited capital, but they differ in who you can raise from and how you can advertise. Let's break down 506B first. Rule 506B allows companies to raise money from unlimited accredited investors up to 35 non-accredited investors who meet sophistication requirements. However, with 506B, you cannot engage in general solicitation. That means you can't publicly advertise your raise. No social media posts, no mass emails to strangers, no public announcements. Your investors must come from pre-existing substantive relationships. This makes 506B a quieter, more relationship-driven exemption. It's widely used by private equity groups, hedge funds, and companies that already have a strong investor base. Now let's cover 506C. This is the key exemption that changed everything. Under 506C, the SEC allows general solicitation. You can publicly advertise your raise. You can run ads, speak on podcasts, go on social media, host webinars, and promote your offering broadly. Now there's a catch. You may only accept accredited investors, and you must take reasonable steps to verify them. A simple checkbox on a form is not enough. Verification usually requires a CPA, attorney, or third-party service to confirm income or net worth. Thanks to the 506C, private companies can now reach investors worldwide without the restrictions that used to exist. This is why private placements have exploded in popularity over the last decade. Now let's define an accredited investor. The SEC considers someone accredited if they meet one of the following criteria. Income test: $200,000 a year in individual income or $300,000 joint income for the last 2 years, with reasonable expectations of the same this year. The net worth test: over $1 million in net worth, excluding your primary residence. Professional certifications: certain financial licenses like Series 7, 65, or 82 automatically qualify an individual. Entity accreditation: trust, family offices, or companies with more than $5 million in assets may also qualify. These definitions exist because accredited investors are presumed to have the financial sophistication to evaluate investment risk. Now let's talk about what companies must file. Even though 506B and 506C are exempt from registration, companies must file a Form D notice with the SEC within 15 days of the first sale. This is not a review process. It is simply a notification. Some states also require additional filings under blue sky laws, although federal law preempts most state requirements for 506 offerings. This is why companies using Regulation D often work with attorneys who specialize in private placements. The rules are manageable, but they must be followed precisely. Before we wrap up, here are the biggest misunderstandings founders have about Reg D. First, Reg D is not only for startups. Established companies use it to raise growth capital, expand markets, acquire competitors, and build infrastructure. Second, Reg D is not a loophole. It is the most widely used and most compliant private offering exemption in the world. Professional investors expect it. The SEC monitors it. It is legitimate and essential. Third, Reg D is often the first step towards larger offerings, including Regulation A and even going public. It builds your shareholder base, your governance structure, and your capital track record. Fourth, Reg D is where most real capital sits. In 2023 alone, more than $2.7 trillion was raised under Regulation D, far more than all IPOs combined. If you understand Regulation D, you understand the core mechanism behind private finance in America.